Hi, everybody. Ian Miller here from MCT. Welcome to our webinar, Advanced Hedging Tactics and Techniques. As usual, we're just going to let the room fill up for about 2 minutes before we get started. So if you'll just hang with us, we'll rejoin you shortly. All right, everyone. Hello again. Thanks for joining us for this Advanced Hedging Tactics and Techniques webinar. My name is Ian Miller. I'm the CMO here at MCT. We're happy that you could join us. It's my pleasure to introduce our speaker today, Bill Berliner, MCT's Director of Analytics. Bill's had a long and productive history before MCT, but most recently, I'm proud of his contributions to leading MCT and our clients through the market volatility associated with the pandemic. He's been a constant source of analytics and helpful information throughout that time. Bill also just put out a good white paper last week on the link between loan prices and the MBS market. If you haven't had a chance to read that, I encourage you to do so. It can be found on our website. With that, I'll turn it over to Bill for our presentation today. Thanks, Bill.
Great, thank you, Ian. The interesting question that comes up, at the beginning of these sorts of presentations is what constitutes advanced hedging tactics in a pandemic? And a couple of things come to mind. It's not so much, as advanced as deeper and better understanding of market dynamics, ways to deal with the unprecedented outcomes that we've seen, and some of which we'll talk about in the course of this presentation, and then also understanding the use of alternative instruments and interpreting some of the data that you see in this type of environment, and giving you some tools to use, giving investors and hedgers and lenders tools to use to better understand and navigate these sorts of unprecedented times. So starting off, let's talk a little bit about market conditions. This is just the Treasury yield curve, say the 2-year, the coupon curve, essentially the 2-year through the 30-year over some periods of time. And you can the takeaway point from this graph is simply that the yield curve is really pivoting around the short end. It's really being driven by intermediate and long yields. And you can see that from this graph where you look, and which shows the dark line is the 2 10-year spread, and the red line is the 10-year Treasury yield. And you can see that starting in February, when all of the coronavirus concerns started to hit the market, that the shape of the curve and the movement of the 10-year are very highly correlated, which kind of implies the fact that, implies and highlights the fact that the curve is really being driven by the long end, and the short end is really pegged in place by Fed policy. It's also, it does kind of highlight the fact that, there's speculation about the Fed adopting some form of yield curve control regime, which basically would mean they would be targeting short yields essentially to some level, and basically buying treasuries to kind of pin or cap, if you would, yield at a certain level. And it might even go out as far as the 5-year Treasury. So you'd expect to see that the curve, the shape of the curve would really shift around the longer maturities, while the shorter maturities are probably going to be not move a great deal over the as long as we're kind of in a pandemic economy, if you will. This is the Fannie current coupon spread over the 5-year Treasury, and you can see that since mid-June, it's tightened pretty substantially. Now, I've written about this on several occasions. The current coupon spread or rate itself is a kind of a nebulous measure because there's really no great way of measuring mortgage or MBS yields without taking into account prepayment speeds and all the distortions associated with what is the current even coupon at this point. Like, for example, last week, the Ginnie current coupon rate dropped 24 basis points from July 2nd to July 10th. Now, Ginnies did okay, I guess, but did not do a 24 basis point tightening. What it reflected was the fact that Bloomberg, whose data I'm using for this, went from using the Ginnie 2.5 coupon to using Ginnie 2s. So you had this big, one-time disruption in it because the spread of the Ginnie 2.5 is very different than the 2. And those sorts of things tend to disrupt trying to look at MBS spreads over some extended time period. That said, MBS have performed very well, and even over the past week, have if memory serves, they've tightened basically every day, especially the Fannie 30-year stack has tightened every day since since the beginning of I think since the middle of last week. Now this is the Fed's weekly purchases of agency MBS, and this is interesting in a couple ways. You can see how MBS purchases had declined to almost very minimal amounts in 2019 and early 2020, and then in March, when the MBS market looked to be stalled and basically moving in the opposite direction of the Treasury market rally, the Fed unleashed a purchase program of starting at $40 billion a day, and I think that started around March 20th or 23rd. And you can see that for the purchases picked up. And keep in mind that the Fed reports this data from Thursday to Wednesday, so it's not Monday to Friday, and so there's a little bit of a distortion in that. But you can see for that week, when they really were purchasing huge amounts of MBS, they bought a total of 156 billion in that 1 week, and now their purchases have backed off, and they're doing somewhere in the neighborhood of 3 to 5 billion a day, depending on the day, which kind of equates out to somewhere in the neighborhood of about 20 billion a week. And you can see that. But the other thing to keep in mind is, if you look at the left side of the graph, that's what the Fed was doing in mid to late 2012, when they really started the program of quantitative easing and purchases. So the performance that we mentioned in the previous slide is certainly being enhanced by the fact that the Fed is still remains very active buyer of agency MBS, even though they're buying nowhere near what they did in March and April during the height of the disruptions in the MBS market. This is an interesting chart. This is the MBA's mortgage credit availability index, and you can see that it has declined a great deal since February. This is a monthly measure that's put out by the MBA, and it shows the composite measure as well as the measure for government loans and jumbo loans. And the striking thing to me is that while the composite index is off about 30% since February, which reflects the tightening of credit standards that we saw then and continue to see, the jumbo index is off by 56%. And the interesting question is, why is jumbo credit availability so much worse, and why has it declined so much more than either government or the overall index? So there's a couple of things that come to mind. One of them is just general investor concerns over the performance of the sector, given the the prevalence of the virus and the difficulties that they've had in controlling its spread. Also, the possibility of a lack of liquidity for normal buyers of non-agency securities. Do they have the funds to actually go out and buy these securities? As well as the fact that it is kind of a feedback loop in there. If investors don't have the cash to put to work, they're not going to put inquiries into the desk, which in turn feeds back to where loans are being offered to consumers and what loans are being offered to consumers. The other part is the concerns that investors have over buying bonds that lack government guarantee. Even though in the current environment, the jumbo securities that are that have been created and would be created have about 15% subordination, which is more than triple what we saw during the height of non-agency issuance in, say, up to 2007, 2008. It's kind of me. One thing that strikes me is that if that number, concern number 3 is a big factor, it doesn't bode well for the privatization of the GSEs. Are investors going to want to buy MBS without an explicit government backing? And the question is, how much backing, what sort of backing, and such. But I personally, just speaking for myself, I'm not super optimistic about privatizing the GSEs until they figure that part out, that how much will investors buy and at what levels will they buy MBS if the sector doesn't have an explicit government guarantee, which Freddie, Fannie, as well as Ginnie have essentially had since 2008. This actually shows the 5 and 10-year Treasury realized volatilities using a 40-day look back. And it's interesting in a couple of ways. The main thing here is you see the red line is the 5-year Treasury, and you can see that the 5-year Treasury realized volatility is extremely low, and this is basically plumbing the all-time lows seen for the 5-year Treasury. And I think that also goes back to the possibility of the possibility of the Fed in instituting yield curve control and basically capping, yields up to the 5-year at a certain level as part of the overall quantitative easing that they're doing and trying to support the economy through the current difficulties. So now let's talk a little bit more about volatility, but rather than talk about realized volatility, historical volatility, I'm going to introduce you to, if you're not familiar with it already, to the swaptions market, which is basically a market for options on swaps. Now, the interesting thing about it is it provides, unlike other option markets, it really provides a term structure for volatility that I find very interesting. And even though, you may not be trading in it actively or ever, it still is something that I think mortgage people need to keep an eye on because it does offer interesting indicators to what's going on in the volatility markets and how that flows through to what's happening with MBS and other callable assets. So the swaption market trades options on swaps for various tenors, or the maturities of the swap, and expiries, expirations. It ranges from 3 months to 5 years. And what's unique about that is if you look at, say, the Treasury futures options, the furthest right now you can go out to for the expiration of an option is to December of 2020, which then the options themselves basically expire late in November 2020. Whereas here you can go out as far as 5 years on an option, which makes it very unique and very interesting to watch. This matrix, if you will, is quoted in annualized implied volatilities. And implied volatilities are basically the output of an option pricing model where the market prices of the options are an input and the volatility component is the output of that. It's kind of a backwards way of people normally thinking of the pricing models. You're using the pricing models to kind of normalize pricing in the same way that quoting MSRs and IOs in multiples allows you to normalize and compare in that market. And we'll talk about a little bit more in implied volatilities later on in this material. But this is an example of just visualizing the swaption surface. The leftmost is the surface as of last week, and you can see it's pretty normal. It's upward sloping, and the longer expiries are higher than the shorter expiries, as well as the longer maturities are higher than the shorter maturities. And it's visualizing that three-dimensional graph and matrix that we saw before. Now the other, from March 20th, the height of the weirdness, if you will, is basically that looks kind of like a flapping bed sheet, and the market was basically inverted, where the very short volatilities and tenors were the higher than the other sectors of the curve. And that is interesting to me because it's kind of, those kind of abnormal markets are kind of indicative of what's going on in other sectors. So the one thing that you can look at, and if you didn't want to look at that, if you find that three-dimensional surface to be somewhat problematic to visualize, think about it in terms of, kind of the same way with a yield curve. People look as the 210 spread as a proxy. Look at the volatility term structure in terms of what professionals would call gamma vega, or the gamma vega percentage, and that's a ratio between short and long-term expiration swaptions, if you hold the swap tenor constant. And, basically, and the gamma and vega both are kind of option terms. Gamma is Greek for the short-term volatility, basically how much the change in the first order effect takes place, the same as analogous to convexity within the MBS sector. Vega is long-term volatility, which is a much more nebulous term if you think about it in option speak. It's kind of the general perception of volatility. And normally, that ratio is around 100% or less if you look at the implied volatility of the short term, the gamma versus the long-term vega. But what you see during market disruptions is that that percentage goes to like 120, 130%. It goes to a much higher percentage. What that's indicating is that traders are bidding up short-term options in an effort to better maintain the duration of their portfolio. They're using it as a hedging vehicle to more actively manage the duration of their portfolio. And they're bidding up the short-term volatility to that effect. And what's interesting then is it kind of, if you look at that, and look at this graph, the black line shows that gamma vega ratio, and you could see that it approached 100 and I think 190% in mid to late March, and then backed off. But you see that, and it corresponds very well, and looks to be a bit of pretty good leading indicator for the realized volatility that we talked about before. For, again, this is for the 10-year Treasury, not the 10-year swap, but you still can kind of get a feel for what's going on in the market based on that ratio. So what I do, I keep an eye on that. It's very easy to pull it down from Bloomberg and just track the implied volatility of, say, the 3-month into 10-year swaption versus the 3-year into 10-year swaption, and watch that as kind of a leading indicator of volatility, because volatility extends the higher volatility or changes in volatility reflect and will lead to changes in MBS, because mortgage-backed securities, being short a prepayment option, are impacted by changes in volatility. Now, the question we get a lot from clients is, how are loan prices doing relative to TBAs? How are my hedges working? And I ran this for going back to mid-June for conventionals and govies. So for conventionals, I ran the 3 1/8 versus Fannie 2s, using a 1-day lag, and you could see that the prices themselves are moving pretty well, pretty much in lockstep with the TBA prices. And I say investor A, investor B, out of respect to the correspondents whose pricing we're using. But they're two major correspondent investors. But you can see that the loan prices are moving very much in concert with the TBA prices. And you can see a very similar thing in the FHA market. I use a slightly higher note rate there, but also used Ginnie 2.5s, again using a 1-day lag. And basically it indicates that there's not a great deal going on in that sector, unlike what we saw in March and April, where loan and TBA prices decoupled. We're seeing a very good correlation between them at this point, which is what you'd hope to see as a loan and pipeline hedger. So now a question we get a lot, both from clients and I get internally from MCT's traders, is let's look at 2% MBS. So both conventional and the Ginnie markets are offering trading in 2% TBAs. UMBS or Fannie 2s have developed as a very solid liquid coupon. It comprises on any particular day 20 to 40% of 30-year trading activity, according to Trace. And there's been a couple of days, even this week, where the more Fannie twos have traded than Fannie two and a halves. Previously, Fannie twos might be, say, 75% of Fannie two and a half trades, but twice this week, Fannie twos have there's been more activity in Fannie twos than Fannie two and a halves, which basically is, kind of implies that the liquidity is improving and the general, it's being really utilized as a trading vehicle and as a hedging vehicle. Now, Ginny twos not so much. Liquidity developed much more gradually. Like a big day in Ginny 2% trades is, like 2-3 billion, and it works out to be somewhere in the neighborhood of 3 to 8% of Ginny volumes, which are in turn much smaller. It's a much smaller base. The most active day I think we've seen so far is about 4.6 billion versus on the same day 68 billion in UMBS twos. And also that illiquidity is reflected in very special dollar rolls for the Ginny 2 coupon. First of all, here's a graphic illustration of the percentage of daily trading of the UM 30 and Ginny 2s, or all Ginnies, excuse me, not just Ginny 2s, but all Ginny 2%. This is a 3-day moving average to smooth it out a little bit, but you can see that the share is much higher in conventional twos than in the Ginny sector. And here is the rolls. As of last time I checked this morning, the Ginny 2 July-August roll was offered at 16 plus. And considering that the break-even value of that roll is about 3 1/4 30-second, that just means that it's extremely, prohibitively expensive to hedge using that coupon and is really risky. If it could trade at 16 plus, I have no idea what the peak level is could be. It's driven by technical factors at this point. You can see that while Ginny 2.5s are also trading special, it's much less. Basically in a 7-tick roll, it's trading about 4 to 5 tick special, which is still special and still makes it relatively expensive to hedge. But the Ginny 2 roll is just extremely expensive, and that's why we've recommended to our clients and traders not to use Ginny 2s until the liquidity improves. And one of the indicators of that will be more normal rolls, and you probably want to watch it over a course of several months, because the rolls do also tend to expand and get a little distorted as you approach notification. Notification for Class C in July is tomorrow, so you probably would want to watch it through a couple of cycles, as well as watch those volumes before you started getting traded actively in that coupon. Now, the other interesting thing I found is that the lack of a Ginny 2 coupon has impacted lending and lending, primary lending rates, because what happens is, keep in mind that both in conventionals and in Ginnies, lenders have to hold 25 basis points of a minimum of 25 basis points, or more accurately, the spread between a loan's note rate and its coupon rate has to be a minimum of 25 basis points. In Ginnies, that accounts for the 6 basis points of guarantee fee, as well as the 19 basis point minimum of servicing. So that means that if for the Ginny 2.5, the lowest note rate, that can go into a Ginny 2.5 would be 2 3/4. And versus with the trading of a liquid Fannie 2, now basically a 2 1/4 can go into the liquid coupon. So what that's done is it's really changed the distribution of note rates that lenders are locking. This is data on a percentage basis from MCT's client pipelines, and you can see that while there's a reasonably normal-looking distribution of conventional note rates, Ginnies are basically pegged. There's a 30% of the Ginny pipelines were at 2 3/4. So what was happening is, as rates were declining, a lot of lenders were reluctant to create lower note rates because they really have no vehicle to securitize it in. So what they would be doing, their pricing would reflect increasingly large credits, or negative points. So that's why you create this very odd distribution of Ginnies, whereas the conventional note rates are much more normally distributed, using very broadly, not a statistical term, but you can see that it's much more normal. And it also does highlight the fact that how much the development in the conventional space of the 2% coupon has helped kind of distribute loan rates lower within the coupon stack. Like today, for example, Freddie Mac's survey rate reported at 298, an all-time low, first time below 3%. And I'd argue a lot of that, even though Treasury rates haven't moved a great deal, that's basically reflects the fact in a lot of ways that lenders can put the lower rate loans into a 2% coupon, securitized coupon, so it improves the distribution and ability to quote lower rates. And I'd argue that that's a factor that has helped mortgage rates decline whereas before the 2% coupon developed liquidity, you kind of saw the same effect. Even though Treasury rates were at roughly the same level, the distribution of mortgage rates was much higher. So this is a very interesting development that bears watching. So now what comes up is one thing that came into pass in mid-March was one day we walked in and we're using Bloomberg's model durations, and the duration for many Ginnie coupons suddenly went negative. Part of it was a change to their model, I believe, but when you walk in one day and you see that Fannie 2.5s had a duration of somewhere in the mid twos, and the Ginnie 2.5s and threes had a duration of negative, hedging models are not made to deal with negative durations, as well as the fact that it is a very abnormal occurrence in the market. You do see it, but you see negative durations for things like IOs and servicing because the prepayment effect, as rates drop, prepayments pick up and the price will drop. That's a kind of an effect you see in part in the TBAs, but because and coupon paying and principal paying, MBS, because of the presence of the principal. Now keep in mind, OAD is an option adjusted duration, and that's just a form of effective duration where the scenario prices that are generated are using OAS functionality. But this kind of created a conundrum. Is okay, what are you supposed to use to hedge? Are you supposed to hedge to a negative, duration? Not so sure. Most assuredly not, I would argue. But first of all, what does a negative duration imply? It implies that prices go down as yields drop and prices go up as yields rise. Exactly the opposite of what you would expect to see with a bond. And as I mentioned, it makes sense for IOs and servicing, but very rare for principal paying bonds. The question is, okay, why did they become negative? And a lot of it is, the high dollar prices, but really the fast and unpredictable prepayment speeds that we have experienced in the Ginnie sector. It's been well publicized as to how fast the speeds have been, but I'll show you something that's very interesting in a second as to how the speeds have behaved. So then it begs the question is, okay, what duration should traders and pipeline hedgers use? And what should you use in the absence of a model duration that you trust? And also it does, generally speaking, you would say, well, that's because of fast prepayment speeds, but how does that translate into negative durations? And we'll look at that in a second. So at first glance, the Ginnie and Fannie speeds don't really appear to be that much different. These are recent 1-month CPRs sourced from EMBS, a major data provider for prepayments. And these are for the UM30 and Ginnie 2 jumbo multi-issue with both 3% coupons for years issued 2017 to 2019. And superficially, the prepayment speeds, these are 1-month CPRs, they don't appear all that much different. But when you look at the prepayment behavior of, say, in the Ginnie sector over time, you get a very odd pattern. And if you see that, what this is telling you, these are the multi-issuer pools that were issued from January 2018 through August of 2019, the Ginnie 2 multi-issuer threes. And that period until like the summer of 2019, that was a period of relatively high interest rates, and so most of the 3% pools spent much of their time being out of the money. But you still see like these really early spikes in prepayments. You see, for some pools, you see spiking up to 65 or so CPR in month 8, and that's very, that's not what predicted by any mortgage prepayment experts that I've ever talked to. You've even seen one or two of the pools be, peaking in month 4, at 40 something, neighborhood of high 30s, low 40 CPRs, as well as, something in the high 40s, in month 7. And in the average, which is just an unweighted average of all those pools, also shows this spike of, into like the 25 CPR area in month 9 for a Ginnie 3 that, for most of that period had no refinancing incentive. And that factor is one of the things I think that troubles prepayment modelers, and one of the reasons that there's such a disparity and dispersion of prepayment speeds, as I'll show you in a second, based on projected models. So now the question, though, is, okay, if I don't want to use the negative durations, what should I use? One possibility is to use the modified duration, which is the cash flow duration that you can calculate based on using a single speed that comes out. So, for example, if you ran Ginnie 3s and you ran it at the median PSA, you would get a duration of somewhere around 3, and that's a modified duration. That's just based on the weighted average of the amount of time that the present value of the security is outstanding. It's a very simple calculation. It tends to be, the benefit of that is not negative, but the problems are there's no consensus on prepayment speeds. The dealer speeds have ranged from anywhere from 170 PSA to, as I'll show you in a second, to 1,000 PSA, with a median of like 540-ish. So using those duration ranges from like 2 to 6.5. 170 PSAs in my mind is clearly too slow. 1,000 is, I don't know. It seems really fast. And also modified durations are always going to be longer than the effective durations, so it's kind of, they're always a distortion associated with them, which is why we really don't use them very much for hedging purposes. Now, an alternative would be to use empirical durations, which is simply to regress daily price changes versus changes in Treasury yields. The benefits, again, they're not negative. And actually, it's useful. I find it, empiricals are useful just to keep a check on what's going on in the market as to how the securities are actually performing. But the problem that we'll see in a second is that they're not consistent, and they also reflect exogenous activities and factors, mainly like the Fed. And you see, this is the 60-day empirical duration to the 10-year, using the 10-year Treasury as your yield change. And you can see that both that they're not consistent at all, and you also see that big spike in the durations in early June. And what that reflects is that incorporates that period back to March, when the Fed suddenly started buying, 40 billion a day of MBS, and MBS mortgages, the MBS sector grossly outperformed the Treasury sector. That period of during late March, when MBS prices rose by like 2 points a day. This reflects that, and then now it trails off as you look forward, because remember, it's a looking back type of analysis. So now it would tell you that Ginnie 2.5, the empirical duration is somewhere in the neighborhood of low 2s, or 2.5, call it, and Ginnie 3s is somewhere in the neighborhood of 1.5. But the question is, okay, how do you use it, given especially that inconsistency and volatility of those duration numbers? So what we've done internally is just kind of use some percentage of the conventional durations that the model uses, and the question is that reasonable? Has that performed well? And what you'd expect if it had performed well is that the daily duration neutral performance of the two securities would be would be in line with each other. So here we've looked at the daily duration adjusted performance of Ginnie 2.5, Ginnie 2.5, and Fannie 2.5, using those durations, using the the model durations for the Fannies and 75% of the Fannie model durations for the Ginnies. And you can see that the 2.5s have pretty much moved in line with each other, which is what you'd expect if the durations were doing a good job of, giving you a good idea of the overall risk of the position. You can see you get a pretty similar picture from the 3s, which leads us to believe that using like 75% of the duration is a pretty useful way to handle the durations. The durations of the 2s, of the conventionals, will change as the market changes, and using some percentage of those, while not perfect, will give you a pretty good sense of what's going on. And in doing this, I tend to think back to the old Warren Buffettism. I'd rather be approximately right than precisely wrong. But the other question that comes up is, and I mentioned the model speed. This is the Bloomberg screen for Ginny 2.5s, and this shows the model speeds that dealers provide to them, and then Bloomberg Daily calculates a median speed for each of these scenarios. You can see here, this is the unchanged scenario, the 0. These are rates down scenarios, and these are rates up scenarios, and these are parallel shifts of the curve. You can see that the median speed in this case is 405, but the speeds in this case were ranging from 347 as a low to 820 as a high. And in a down 100 scenario, it's ranging from a low of 538 from one dealer to 1667 from this dealer, JP Morgan. And you can see that, and these down here, this is BAM is Bloomberg's prepayment model. You can see that their model, in a parallel shift unchanged scenario, ranges from a base case speed, an unchanged speed of 782 to somewhere in the neighborhood of 2,000 PSA for 100 basis points down. See, there's very little consensus as to what the right speed's supposed to be. So now, one thing you can do with that, though, is you can take those and kind of calculate your own very crude durations just based on 25 basis point or some up and down movement. And I use 25 as kind of the smallest increment that I'd want to use. So you can see here that at 105.20 at 405 PSA comes out with a yield of 1.07 and change. So up and down 25 basis points using the speeds for up and down 25, and I've interpolated these speeds. So basically, the base speed price is 105 and 20. In this case, using these speeds, and I think this was like one of the slower ones. The price is and you look across it and this diagonal, the price is 105 the buck here, and about 105.28 in the down 25 basis point scenario. So then, to do it using that, you can kind of calculate kind of a crude set of durations using these different speeds, and as quoted by the Bloomberg VALL page. And you can see that using the slowest speed, dealer speed, as well as the medians, you get a duration of somewhere in the neighborhood of 1.5, which is reasonably close to what we're using as the 75% number. Whereas if you use the fastest speeds that they have, you get a duration of -3, which is greater than the model duration, but I'm not, suggesting that they're directly comparable. But it does imply what's going on with this, that the fact that, the very high base speeds as well as the very high speeds in the rates down 25 scenario are what's driving the durations, because you can see that in a rate up 25 scenario, because of the slowing of the speed, the dollar price actually increases in the fastest scenario, whereas over here, the dollar price declines as you would expect it to do in an up 25. So it just gives you a sense of what's going on and how to get an idea of what is happening with and why these models are not performing as you'd expect based on their histories. So another quick thing to look at, I want to discuss, is optimal pooling in the MBS market. And Ian mentioned that we had just put out a white paper on that, and it's a very interesting thing to me in terms of how does the MBS market translate into the generation of mortgage rates and prices, keeping in mind that lenders really don't offer, as you know, offer rates per se. What they're doing is offering pricing at the different note rate stratas. So the inputs for that calculation. So the question comes down to, if you have, say, some note rate, how would it be securitized? What would be the best execution for it to be securitized? And the driver of that is a combination of TBA prices, the level of guarantee fees, as well as the GSE guarantee buy-up and buy-down multiples. And they provide a grid monthly for securitizers that do these buy-up and buy-down multiples. I'll show you in a second, some quick calculations. But you have two options. You can pool down into the lower coupon and either retain the excess servicing or sell it to the GSE at what's called a buy-up multiple, is essentially them giving you a bid for IO, essentially. Now, pooling up into the higher coupon means that you probably aren't going to have enough cash flow to pay the guarantee fee in full, especially at the current rates of guarantee fees, which are about, roughly 45 basis points for a 30-year conventional. So you have to make a one-time in conventional space, Fannie and Fannie, you have to make a one-time payment to the GSE to cover this shortfall at what's called a buy-down multiple, which is generally a lot higher than the buy-up multiple. GSEs are making markets in IOs essentially, and they're not shy. There might be a two difference in sometimes between the buy-up and the buy-down mults. So you can see here, this is straight from the white paper. You can see here, though, that in this case, a 3 3/8, assuming a 45 basis point guarantee fee, means that you would have 17.5 basis points of excess servicing if you pool down into 2.5s, UMBS or Fannie 2.5s. Whereas if you pooled up into 3s, you would have 32.5 basis points of shortfall that you'd have to buy down essentially. And using the various multiples, which are reasonably in line with where the current market is, you can see that that in this case, best execution will result from slotting or pooling down into Fannie 2.5s for this loan. Now, the interesting thing in this environment is that pooling down is almost always the best option unless you have a very big spread between your note rate and the desired coupon. Keep in mind that the maximum spread as of last spring is 112.5 basis points. So basically, a 3 1/8 note rate could be pooled into a 2, but a 3 1/4 can only be pulled into a 2.5. That's the lowest coupon that you can pool into. So basically, guarantee fees are the thing to keep in mind. Guarantee fees are much higher now than in the 2000 to 2008 period because of the perceived risk of the sector, as well as the fact that there's a 10 basis point, essentially a tax that's put through as part of the guarantee fees. But the fact that the more that the G fees are higher means more of the guarantee fees have to be bought down when pooling up. And since the buy-down multiples are much higher than the buy-down multiples, are much higher than the buy-up multiples, essentially that has pushed execution almost always into the lower coupons. The Ginnie execution is also better by pooling down, and that's a function that the servicing is being priced much better than the coupon swaps, if you will. Like, for example, the Ginnie to 3.5/3 swap is inverted by, I think, about 3/8 of a point. So that factor really impacts the pricing of loans. In Ginnies, it's simpler because you don't have buy-up and buy-down multiples, and you only have a 75 basis point maximum spread between the note rate and the coupon. So there's only a few note rates that you have the option of pooling up or pooling down, unlike conventionals. But you still have this case where it's almost always best execution to pool down. So the implications of that for hedgers is you have to think about shorting the lower coupons if liquidity is supportive. Now, so right now, what you're seeing is people using, Fannie 2s as a hedging vehicle, but really hesitating to use 2.5s. But I think if liquidity improved and the rolls improved, that hedgers would also start using Ginnie 2s as a hedging vehicle. Again, if liquidity and cost is supportive. Now, consistent pooling down also means that pool WACs are much higher than in earlier periods, and more accurately, not just the WACs, but the WAC spread, the spread between the weighted average note rates of the loans in a pool versus the coupon rate. So in other words, look at a second. This actually shows for two different periods. The red line is the Fannie 2.5, basically the WAC minus the coupon for Fannie 2.5 that were issued from October 2019 through June of this year, versus Fannie 5s, the current-ish coupon at that point in time between April and December of 2009. And you can see that that spread was much tighter, partly because guarantee fees were lower, the market was different, and that 40 to 60 basis point spread that we're seeing here is very much in line with what we would have seen from the era of, like, say, 1999 through 2010. And if you talk to dealers, they, are very concerned and very cognizant of the fact that WACs for pools are very much higher, and these WAC spreads have expanded and are very much higher because that impacts in turn the prepayment behavior being driven by the note rates of the loans in the pools, not by the coupon rate. So arguably, baseline speeds are much faster than they would have been if the note rates are of the loans going in the pools were lower. In turn, if there was really an advantage to pooling up rather than pooling down. But one thing that does come into play, and it's best shown in the Ginnie market, is that the best execution decisions can be offset by, in the specified market, by the pay-ups. And here I'm showing what are, kind of current or, say a week ago pay-ups for maximum balance Ginnie 2.5s and 3s, and these would be securitized as custom pools, not the multi-issuer pools in Ginnie, not the jumbos. But you can see that the pay-ups, it's interesting that there are pay-ups for 2.5s, but the pay-ups are certainly much higher for 3s because of the increased prepayment exposure that you have. So taking the 150K balance, for example, you have a 40-tick pay-up in the market for a Ginnie 2 3s versus the 12-tick pay-up for Ginnie 2.5s, all other things equal. So then what has to be done is, assuming you have a 65 basis point, execution difference between pulling into 3s and 2.5s, then it's a case of, for a lot of these categories, the incremental spec pay-up offsets that production give up. So in other words, for 150K pool, if you might be giving up 65 basis points in execution by pooling into 3s rather than 2.5s, but you're picking up 88 basis points by the fact that the pay up for a 150K Ginnie 2 3 is much greater than and it's 2.5s. So that means that in that case, you should. So when looking at what pools are going to be created, as securitizers in the Ginnie market, especially, you should be looking at the trade-off between pooling down into the coupon, which you would be looking at for normal generic loans, versus the spec pay-ups that you can get by pooling up into if you can get a pay-up for these categories. It also suggests that down the road, if the execution difference kind of narrows, especially in the conventional space, you may be able to create a spec product, a category of low WAC pools. In other words, say UMBS 2.5s with a maximum WAC of 3% rather than the 340 to 352 you see now. So it's definitely something to keep in mind going forward if execution, moves back to where it makes sense to do that, and that would again be driven by the trade-off between the execution difference versus the incremental payout. And the last thing we're going to discuss is using options as a mortgage hedging vehicle, the pluses and minuses. The pluses are that you can add gamma or that convexity to your profile, and I'll kind of turbocharge your hedge to account for these market changes. And it'd also be a cost-effective hedging vehicle. Now, the minuses are the lack of an exchange-traded MBS option market. So really, the only option category you have at this point in time is, our Treasury futures options. But you can also, but by doing that, if you use those options, you're creating several different kinds of risk. You're creating basis risk between the mortgage market and the treasury market. You also have yield curve risk because, what do you use? As well as the duration risk. The 10-year is a longer duration than what you see in most mortgages, and generally current coupon mortgages tie pretty well to the 5-year, but not great. So you have that risk too, whereas your durations are not too closely matched. Now here's a brief section of discussion of option terminology and concepts, and most of you will be familiar with the difference between a put and a call. A call gives you the right to buy an asset at the price. A put gives you the right to sell it. What an option premium is. But I highlighted in red two concepts that we're going to discuss a little bit is the intrinsic value versus the time value of an option. The intrinsic value is the difference between the underlying price and the strike price or zero. It's binary. It's either a positive number or zero. For a call, it's basically the market price minus the strike price or zero. And for a put, it's the opposite. It's the strike price minus the market price or zero. Now the time value is essentially the value of the option based on the amount of time to expiration, or essentially the value of the option in excess of the intrinsic value. And out of the money option, the entire value is time value, where in the money option, you can actually calculate very easily the intrinsic value. The remainder is the time value. So as we mentioned, we only recommend utilizing exchange-traded option because of the liquidity, the transparency of the sector, as opposed to using some form of an over-the-counter option where you really are not seeing transparent pricing or volumes or anything, and it also becomes really much a one-way market. So there's two tactics that we see used fairly commonly and used for our clients. One of them is to use options to smooth out the pipeline profile. So the pipeline P&L has a frown profile because pull-through exerts the same effect as negative convexity. As the market sells off, pull-through tends to expand, which makes the pipeline longer. And as the market rallies, pull-through tends to drop, which makes the pipeline essentially shorter, which is essentially the definition of negative convexity. So you can flatten the profile with a combination of puts and calls, a collar of sorts. The other one is to get kind of a supercharged or a turbocharged hedge, which would benefit from the leverage of options themselves, as well as that option values often increase and have higher implied volatilities, using that term again, during periods of market volatility and market distress. Keeping in mind, implied volatility is just that output if you plug in the price as an input into your model. So basically using the deltas to trade is basically the deltas, that's what gives rise to the term optionality. Your base relationship is an at-the-money delta is 0.5, basically half of the duration of the underlying asset, or for a put, it's negative 0.5. Out of the money deltas decline to approach zero, okay? Whereas in the monies kind of approach 1.0, they approach 1, whereas it's a 45-degree line. And at expiration, the deltas either go to 0 or 1. It becomes binary. And this just kind of highlights that for an option with some time to expiration. You can see how at the money, the delta is 0.5. A tangent line would basically be half of, it basically a 45-degree line, versus the delta, out of the money is something in the neighborhood of 0.3, versus in the money, it's about 0.75, and as you get further and further in the money, the delta approaches 1. So using them, think of the delta as the ratio of option duration to the duration of the underlying. Okay. So these are two examples. If you're going long volatility, you might be buying 100 calls, at the money calls, and shorting 50 of the underlying. And you could see that as the market sells off, you are getting shorter, and as the market rallies, you're getting longer. So what it does is it basically, to hedge, to stay flat, you would be buying exposure here, and selling exposure here. So basically buying low, sell high, that's a profitable strategy, but it's facilitated by paying the option premiums, and the holder benefits from higher volatility. Now, the opposite of that would be going short volatility, so selling 100 of the at-the-money calls and buying 50 of the underlying. In this case, the market sells off by a quarter point, you get longer. Market rallies, you get shorter. So you're buying high and selling low. That's an unprofitable strategy, but it's offset by the fact that you're receiving the option premium, and the holder benefits from lower volatility. And just an idea, of what happens over time. I mentioned that the deltas get relatively binary. The option decay increases, accelerates as the option approaches expiration. You can see it's pretty much of a flat line until you get within 3 weeks of expiration. And it's kind of a weird, financial markets form of relativity, I like to think of. And I always like to use that quote from Elizabeth. Her supposed last words were "all my possessions for a moment in time." And applying that to the option market, you really get a sense of why value deteriorates so rapidly as you get closer to expiration. So here's a smoothed out pipeline profile. The blue line or the black line is the normal profile. It's a little bit squashed, it's a little bit exaggerated, but you can get a sense of what's going on. Versus while you do have a frown profile with, including the option collar, it's much flatter. And it's also slightly bullish profile because in this particular case, which I borrowed from an old record, the client was long 45 10-year puts and 25 30-year calls. So you had something of effect of, it was kind of a modified collar, if you will. And the position is somewhat bullish, even though fewer calls were used than puts, because the calls were on the 30-year bond, which has a much longer duration than the 10-year note contract. That also comes into play in this type of category. Now, the other way of using it is to buy out of the money options to give, the lender performance in big market moves. And a very common thing to do would be to buy some out of the money calls that if there was a big rally in the market and your pull through declined substantially, you would get P&L to offset that from the profit on your calls. There's two ways that you'd be profiting from those. One of them would be leveraging of the position, the delta expansion. The other is the spike of an implied volatility. And this shows kind of interestingly for the 135 June calls from March 2nd through May 15th, you can see that while they move roughly in a straight line, you can see this is a bubble chart where the bubbles actually represent the implied volatility of the option, which is basically means that the time value is expanded. Versus below the trend line, it's the smaller bubbles. And that kind of shows you how the implied volatility expansion also improves your P&L profile, in addition to the fact that you're getting the expansion just by the increase in intrinsic value. But what this shows here too is that the spike in implied volatilities tends to be short-lived. And in this case, the red line is the 135 call implied volatilities. The black line is actually the VIX index, which is essentially an index of equity option implied volatilities. And you can see that the implied volatility, especially on the Treasury note, spiked in mid-March and fell off pretty rapidly, and then kind of stayed in line with each other and tended to kind of deflate, if you will, as the market as things progressed. And you see here the same thing. This is the VIX index daily closes in 2016. And you can see, 2016 being a very interesting and eventful year. At the beginning of the year, you had the Chinese stock market meltdown. And in June, you had the Brexit vote. And in November, you had the election. And you could see that the market did spike, but the spikes were relatively short-lived. So the takeaway point on that, I think, is that the spikes in volatility are often short-lived, so you really have to be fairly active in trading that. And also, options in general require management. It's not a fix-it-and-forget-it type of position because the deltas change with changes in the market as well as time elapses, which means you have to adjust, and the time decay accelerates as expiration nears, so you have to reset them and be aware of your basis and curve exposures. So that's what I have. Thank you very much. And I just want to briefly thank Curtis Richens and Phil Rosari for their leadership in this and for giving me this platform. And also thanks to the management and staff of MCT for a great experience. As Ian will briefly note, this will be my last presentation on behalf of MCT, and I've enjoyed my time here greatly. Thank you, Ian.
Thanks a lot, Bill. Hey, excellent presentation as always, and thanks so much for your years of service at MCT. I know I personally and many clients appreciate the guidance and education you provided us as an expert and as director of analytics, prior to, but especially during the recent crisis. So, we certainly wish you well in your new dream job at Penny Mac. But we're appreciative that you'll stay close and stay connected to MCT moving forward. So, again, thanks for everything, and we wish you all the best, Bill. For everybody else, we will be distributing the recording of this presentation in a follow-up email this afternoon. And thanks for joining us today. We'll have more educational content for you soon. That's it. Thanks, Bill.
Thank you.